So, if you have questions, however you want to do it, if they want to have questions throughout or save your questions for the end, she's more than happy to answer them. So take it away, Brenda. Thank you.
Thank you. So the first thing I have to say is, this is not legal advice today. We've covered that. So anyways, I'm Brenda and I am an insurance broker. And basically what that means is I don't work for just one company. Our company is Goosehead. We're an American company. We're based in Texas. And, as a broker, I write insurance with multiple companies. So, Progressive, Liberty Mutual, Allstate, National General, all of the big players in the industry. With Goosehead, we only partner with insurance companies that are A-rated. And the rating comes from the state. And that means that they're financially strong so that if there was a major loss in an area, that they have the money to be able to pay those claims out. So fires, let's say a fire went through an entire development, then they have to be at a certain level financially to be able to, pay out all of those claims. So that's who we work with. Some names you know more than others because they advertise a lot on major sporting events. And then there's the other names that goes, I've never heard of Lemonade before, but they're a strong company and we do a lot of business with them. So what I do is pretty much we are a tech company. We're a tech company that sells insurance. So from the information that we receive from a client, and I'll go through that with you, we are able to enter that info into our rater, and it will populate for us which insurance company is going to give us the best rate based on the client as well as the property. So from there, we then bridge over and start our quoting. So what this does is it saves your client from calling 7 different insurance companies, the Allstate, the State Farm, every Geico, and saying the same thing over and over. We do that for them. People will ask, so how do we get paid? We get paid by the carrier. Commission rate is pretty much the same for all of the insurance carriers. We call them carriers in our industry. So we don't just push one company thinking, well, that's a company that they get paid with. But when somebody calls, let's say, an Allstate office and they just sell Allstate, that's their only option that they have. So we really do look for price. The key thing with Goosehead is our business model is realtors, lenders, insurance, because you need all 3 components for that little triangle to work. And the better the communication that we have with the lender and the realtor, the smoother the transaction goes, so that there's no closing not happening because they didn't have the insurance component. So anyways, insurance is an interesting beast because we need it for the deal to close, but we really don't know how do you get that number. So does anybody have any ideas of what impacts home insurance?
The value of your home.
The value of the home. Okay, sounds good. That impacts it. There's $100,000 for you. Location, zip code makes a difference, and it's because of crime. So there's $100,000 for you.
Claims, location, claims.
The amount of claims that they've had, both on the home and the person. So if the home that they're purchasing perhaps had a fire 2 years ago and the kitchen was redone, you're thinking as the agent, this is great, brand new kitchen. Insurance is going to say, there was a fire, $85,000 was paid out for that. Yes, from the realtor's point, brand new kitchen, insurance red flags wave, and they want to see that home inspection report because they want to make sure that, yes, the money was used to replace the kitchen and it was done by a licensed contractor so that the wiring is great and it was it was by a certified person and we can write off on it so we know that there's not going to be another fire. So was the main cause of that fire fixed? Same with a water claim. New basement redone because there was a water claim.
insurance, we pull the clue report, it tells us there was a water claim. $15,000 was paid out, they wanna know, what did they do with that $15,000, that previous homeowner? Did they get the basement fixed, or do we still have an issue going on there? So, who said claims? Yep. Now, what happens, there's kind of grand review. So what happens with home insurance and claims is every time a client makes a claim, their home insurance increases, even when they're buying a new property. And then we have a situation where if they've made too many claims, nobody wants them because it's like they're red flag. They're like, well, they're the claim client. And then the only insurance that they can get is what's called the Ohio Fair Plan. And the Ohio Fair Plan is expensive. And it is really expensive. So the fewer claims somebody makes, the better off they are down the road. And claims on insurance last 5 years. So if somebody's made a claim 7 years ago, it's off the records, but it stays for 5 years. And there are companies that will just decline it and say, no, we're not going to insure that person because of their claim history. So what else impacts?
How old the roof is.
Oh, you're so smart. That's my big question. How old the roof is? There you go. $100,000 for you.
Also the material of the roof, I had issues in my house, for some reason, certain insurances wouldn't claim it,
Would
and there was a new roof.
we cover the roof?
Yeah, because some about some type of material on the roof, I had to talk to my cousin about it, and I just found enough of different insurance, I can't remember what my materials on my roof, but it's something, it's like slate gray something, and certain companies, like NJM said they wouldn't cover it, and I'm like, it's a brand new roof, it's literally like, it's not even 5 years old. So, I don't know, I found
Okay.
somebody else.
Okay, that'd be interesting to look at that. So, yeah, the age of the roof is big, especially here in Ohio. There's certain companies, insurance carriers, we call them carriers, that 10 years is the magic age on a roof. That you're in at a tier for pricing if the roof is newer, 0, like new to 10 years of age. Then over 10 to 15 is a different price point. It's like that you remove a discount on there, which increases the home insurance. That is not something that is like negotiable. So that's why, what's the age of the roof? And then over 19 years, they're not going to get replacement coverage on that roof. They're only going to get actual cash value. So they take into consideration that a windstorm comes up, some shingles come off the roof. We're not replacing that roof. That's a homeowner's responsibility to do that. So a roof is key.
A metal roof.
A metal roof is great.
I mean, is it a lifetime?
Even like age of
insurance?
metal roof?
And you know what? They're more concerned about the age when it comes to a shingle roof. If a metal roof is like under 10 years, they're gonna say, this is great. They'll just wanna later make sure that it's not leaking. But a metal roof and a shingle roof, two different beasts. And then where we get it to be really tricky is not all carriers will want to insure that beautiful old slate roof that's 120 years old. And if somebody's buying that, yeah, it's gonna increase the insurance because you don't have as many options. So there's something else that really impacts home insurance. Okay, Caitlin.
Credit score?
Credit score, yep. So we you said there you go, $100,000 for you. We don't see a person's credit score. It's all done on the back end of our technology. However, credit score is really tight. So when the lender says to me, hey, Brenda, this is really tight, they're really a tight, close debt to income ratio. We already know the insurance is going to be higher because maybe their credit isn't that great. So you kind of have to take that into consideration too. And the reason the credit impacts it is there a risk of not paying their bills. So if somebody doesn't pay their bills on a regular basis, the insurance company says, hey, this is your insurance score and this is where you range. So somebody with a high insurance score is going to get a greater discount on their home policy.
I was just about to ask that, because I didn't know nothing about insurance for it, so one time I owed like $2 to USAA, and then didn't realize for the longest time about it, and it actually affected my insurance, like, not my credit, but affected like the insurance score. And then I finally paid it off.
Yeah, they get real funny about that. They want their money. So insurance scores, so someone has their credit score and then they develop what's called an insurance score. We don't see that number. It's done on the back end, but it's what impacts it. Other things that help with insurance rates is does anybody have any other ideas before I give it away? Keep that $100,000 to myself.
Yeah. What about like flood zones, things like that?
Uh,
I mean, that's
yeah.
part of location, right?
Is part of location, we'll get into flood, yeah. Trees, they'll actually ask the person, you need to get those trees removed. Okay, because if they're touching the roof, it's a greater risk for a claim, so they're gonna come out and say, those branches that are touching your roof need to be removed, or we're canceling your insurance. They remove it.
So who covers then, let's say the neighbor got a tree and it's, it's on their property line, but it falls on your house or something, who covers that?
Wherever the tree is the responsibility. So your neighbor's tree hits your roof. That's your neighbor's responsibility. So then you and your neighbor have to go at it because it's their tree. So being a good neighbor is making sure you're not paying somebody else's insurance as well. The claim is made on your insurance to cover somebody else. Just like if you hit somebody else's car, your insurance pays that. Okay, so those are the factors that kind of go into pricing for insurance, and it's all different. And then there's certain companies that we work with that the exterior of the home impacts the insurance. So, for example, Progressive Auto in the state of Ohio, I write that all day. Their rates are really fair. They're very selective about their home insurance. They have the entire market on boats and motorcycles and auto, but they're selective with their homes. They will not insure a home that has wood siding. They want vinyl, aluminum, or brick. They will not take a wood siding home, just not their appetite. You say there's great chance for fire. That's not our market. So knowing all of those things helps us as the agents think, can we bundle and save them money? So, the Patrick Mahomes commercial of the bundling. Yeah, it's true. And the reason we do that, the reason the carriers want the bundle is they want both sides of the business, because then they're longevity of a client. But not all policies can be bundled because certain carriers won't take someone's auto, certain carriers won't take someone's home. So if we can do the bundle, it's great because it saves on the home insurance. It doesn't save them much on the auto, but it saves them on the home. So from, your end, that's super helpful. If we can do the auto, it can save on their home insurance. So what other questions do we have about insurance?
Can you repeat the roof thing again? I got part of it. I said, I know claims on insurance last 5 years, 0 to 10 years is a new roof, but I didn't get nothing else after.
Oh, okay. So it's just kind of tiered. So a new roof is under 5 years. Then what's the acceptable range of insurance is most carriers like them under 10. So anybody that's closing in, and they go by a full calendar year, December to January. So anybody who's closing a property in January, let me quote them in December because the roof is still 2025. And then come next year, January 1, they're going to count that roof 1 year older. So any of my reshops that I do for clients, I like to get that done in 2025 because the roof is a year younger. They don't care, was it put on in January or November? They just go by the year. So, note to self, December roofs are a good thing.
I've had a couple of experiences where clients have closed on a home, they've had their insurance in place, etc. And then they get a letter 2 weeks later that says, if you don't replace this portion of the roof or this, that, or the other, we're going to drop you.
Yeah.
But we know they've already sent someone out to the house.
No, they don't do that inspection for the home until it closes. Because they could waste a lot of time inspecting homes that people don't ever close on.
So they wait until the deal is closed and then they send someone out?
Depending upon the length of closing, yeah, they've got a backlog as well of inspectors coming out. So when you guys are thrilled about doing like a 2-week closing, it doesn't work for everybody else because their inspectors can't get out there within that 2 weeks' time. So they close on the house, they know that they own that house, insurance has been paid. Their inspector comes out and says, hey, we've got a problem here. Now, as the agent, I want to make sure that that problem doesn't ever happen. So I'm gonna look at the pictures and I go, yeah, we got a problem with that roof. If there's not handrails on a stairs on a deck, they're gonna say, yeah, we're going to cancel that unless that gets fixed because it's a liability. So most of the time, the homeowner is going to fix those repairs because, yeah, you need a handrail on your stairs outside because somebody could fall and then you're going to be sued. Or if branches are too close to the trees, sorry, branches are too close to the roof, they're gonna say, those branches need to come down. Take them down, send us a picture, your insurance will get, rescinded, that it's not gonna cancel. So it's the timing of it, of when an inspector can come out.
Do they use like the listing photos and Google Earth images prior to,
If there's
Well,
any
it's
type of a
basically-
red flag and we have to go to underwriting, then they're gonna go, let us, give us a few minutes, let us look at this. Often they wanna see the home inspection report. We as agents, we call that the kiss of death, because it's like, great. And then they'll say, no, we're gonna pass on this one, and then we have to find another carrier for them, if the home inspection isn't clean. But it's when they waive that home inspection, and then the insurance companies say, hey, we need a home inspection to view that, and they don't have one, it reduces our options of who we're gonna write them with, and that's just gonna cost them more money.
Hmm.
Yeah, so in the market where people were waiving the home inspections, it wasn't always a sound decision to be making, so, yeah. What other kind of home questions might you have?
Does it matter if it's a ranch or a 2-story or a split level?
Changes the price.
It does.
Yeah, it does. 2 stories cheaper.
Oh.
It is. There's more space in a ranch. So square footage of the home actually makes a difference. Number of bathrooms makes a difference. So we have to enter all of that information. We just go off the listing. Or we'll ask the person if it's if it's not for a closing, if they're just changing their insurance midterm. The more bathrooms there are, the greater chance that there's going to be a bathroom flood. It increases the insurance. The other questions we ask is there a trampoline? And we always say, please say no. Because there are certain companies that won't insure a home with a trampoline because the liability is greater of somebody breaking their neck and then the homeowner is sued. And that's part of their insurance as well. So,
Wouldn't the pool be part of that too?
yeah, pool costs more on insurance. So, for example, when, maybe a lender is thinking, Matt's thinking, well, why, this is a great house, why is it so much money? Well, they have 3.5 bathrooms and they have a pool. Pool adds the price to the home insurance. They have a dog, it increases the price of home insurance. That's probably my phone just going off.
Wait, you said a dog?
A dog increases it, and then we
So
have
you
to,
guys asked, nobody ever asked me that pets in the house, and I've been insured.
well, yeah, very good agent. And the reason why we have to ask about a dog is the next question is, hey, do you have a dog? And they go, yeah, we do. And then we say, is there any bite history? And if the dog has bitten anyone before, we have to document that. And there's certain carriers that won't insure them. There's certain carriers that will not insure a pit bull or a Rottweiler because of the bite history, and then they could be sued.
And then it impacts their home insurance. So I know right off the bat, Progressive will not insure a home that has a pit bull or a Rottweiler, will not.
So what happens later, let's say, like right now I don't have an animal and I do have Progressive actually, so.
Yeah.
Years go by, I get an animal or I get a dog.
Mhm.
What happens then? And I don't say nothing to them during.
If your dog bit someone, there's no documentation that there was a dog there. So a little bit of that is on you. They could say, you didn't tell us you had this type of a dog. It's the homeowner's responsibility to share information, and it's the agent's responsibility as well. Every so often you're checking in, saying, hey, has anything changed? And they say, yeah, we got a dog. Oh, what type of dog did you get? Oh, and they usually send me a picture. I go, oh, that's so sweet. And if I know, yeah, that dog's fine. We just put in our notes, how's the dog? Mhm.
So, but, okay, I'm just trying to understand what the liability is, if it has anything to do with insurance at all, with the dog. Like, let's say the dog is by somebody, what's that have anything to do with insurance?
The person will sue you. So, for example, on your home insurance policy, you have a category, it's called personal liability. Most agents put it at 300,000. We at Goosehead always put it at 500,000. So Amazon driver comes to your house. Okay, the dog, somebody opens the door, the dog runs out, bites the Amazon driver. Amazon decides to sue you because your dog bit me. And then a claim happens and it's a personal liability claim. So
Oh.
you would have up to, if we wrote it, $500,000 to, that could be paid out for the damages that that person had received from the dog bite.
Okay.
Yeah, or your personal liability also impacts the homeowner for, you're having a cookout 4th of July, here's decided, wouldn't it be a great idea that we all light fireworks and we've been drinking all day, someone blows their fingers off, it happens, those little commercials are true.
Yeah.
And that person sues you and says, hey, Caitlin, you served me beer all day long. This is on you. And you told me, come on, let's light fireworks. They sue you. That's where your homeowner's insurance personal liability protects you. So it's all the things. Yeah.
What about electrical, like knob and tube or?
Oh, yeah. Yeah. It's really hard to find an old home in Canton, Akron that doesn't have knob and tube. There's carriers that will say, is there knob and tube? Many electricians will say it's safe. It is, but they'll say no. So we as agents have to say, has the electrical been updated? And what's the panel like? And is there knob and tube? And certain carriers will take that home and other carriers will not. So we as the agents have to do our due diligence and ask those questions. So when somebody says, hey, just quote this out for me without talking to the client, we can't do that because we have to gather all of that other information in our discovery to make it, a good, honest policy.
So with the knob and tube, like I've been, show different homes where like there's like a little tiny portion, maybe in like a closet or something in the basement, like, is that okay? Just like a little piece, it's not like the whole house, just a little part.
Even if it's been disconnected.
If it's disconnected, yeah.
Yeah, as long
Mhm.
as it's disconnected.
If it's not active.
Well, I've seen ones like, I mean, it's just, I don't know, it's like a little closet room or something, active, maybe something just from, well, it was an old home, so I didn't know, but like the rest of the house was updated for whatever reason.
Yeah. If it's active, I might want to move on.
Okay.
Yeah. Move on.
Does, if you have like an electrician or sometimes our home inspectors write like letters of explanation almost. If an electrician says like the knob and tube is in working, like safe working condition, does that help at all or does it just
It's
not
just a nice
matter?
documentation, but there's
Okay.
still companies that will say, no, that's not the risk that we want.
Okay.
There's other ones that will. They'll say, yeah, we'll take that. Has it been upgraded? We'll take that. So. The other thing that we do at Goosehead, and we have quite a large appetite for it, especially here in Ohio, is investor properties. So, we have some insurance carriers that we work with, and that's all they write. They don't write auto, they don't write a personal home, they write that investment property insurance. The rates are competitive, and it's a nice part. It's actually a really nice part of my business. We have a lot of clients that are purchasing property in Ohio that are in California, and they are great clients for us because they also don't balk about the price of insurance, because compared to California, yeah, sure. So it's that's a part of our business that we do as well, and it's a little bit of a specialty, because some of your captive carriers, like if somebody just dealt with, let's say, an Allstate office. Allstate's a great company, I write Allstate. But they just call their local Allstate to get a quote on an investment property. Allstate does not offer a water backup for an investment property. They should have it. So we have carriers that we use that is going to give them the proper, water backup coverage.
Can I ask you your main character or carrier for investment property?
It's a company called Steadily.
Okay,
Yeah,
do you use Wayne?
Wayne. Mm-mm.
No, okay.
Mhm. So their pricing is really fair, and because this is what they do, they're not as, I'm gonna say, fussy about certain properties. Like they have a lot of, those older homes in Akron that are being, purchased and rented out, and they're not gonna cancel on them. Okay, unless of course they're missing a handrail on the stair. So
When you say investment properties, do you mean, are you talking more like multi-unit? Or are you thinking?
or single family.
Okay,
So-
that are like in maybe less than ideal condition, like are you talking flips? Like a
We-
home that's in rough shape, kind of?
A flip is a different insurance policy as
Okay.
well, and that's more money because it's vacant. So when an investor is purchasing something, we want to know that there's hopefully a tenant in there within 60 days. If there's not, it could very well be canceled, or we have to rewrite it as a vacant property. Most of the time, it's going to be, cosmetically improved, and then it's gonna have a tenant within 60 days because they want to make money too.
Do you do apartment complexes?
No, for personal lines, it's 1 to 4 units. Okay, if somebody's purchasing a property that has more than 4 units, that's a commercial policy, and you need a commercial insurance for that.
5+ units is.
Yeah.
Okay,
Mhm.
commercial.
Is commercial. So, and I don't write commercial, we just do personal lines. So, flood zones. How many of you run into flood zones with properties? Yeah, so the technology that we have, we can pull an address and it will immediately tell us what the flood zone is. And I know that Lisa has called me before saying, hey, can you check on this? And the flood insurance, if it wasn't a flood zone, it would have been something that would have been required by the lender, and it's a separate policy, and it is often in excess of $1,000 a year. So if it's in a flood zone, and so that's a big number, and that could make or break the deal. And sometimes people have found that out afterwards, that it was never disclosed that this is in a flood zone. And then we're running the numbers on it, and I might call the lender's office. I go, you guys know this is a flood zone? And they go, huh. And we've got to then scramble to figure that out. If somebody just wants flood insurance because they want that extra protection, if it's, a flood happens in that area, and 10% of all floods in the US are in non-flood zone areas. So it happens. If we have clients that have moved from flood areas, they always buy flood insurance because they've lived it. So if somebody's moving to Ohio back, from Florida, they'll say, oh yeah, we want flood insurance because they've lived it. Flood insurance for most families, properties is in that $600 range. If it's in a flood zone, it can be $1,800 and it's an additional policy. And if it's in a federal zoned flood area, it has to be in place for that property to close. And the lender won't have that close. It can't close unless there's a flood policy attached to it. And it's not part of their mortgage, it's a separate payment that they've got to come up with that. So, and a mortgage company is always notified if at renewal, they don't pay that flood insurance. They're immediately notified that, hey, they're in default of their loan. Yeah, so a flood's pretty big. So, but if you're ever in a situation where, is it a flood, isn't it a flood? Run a quick flood report on it and give you the zone right away.
This is a question for insurance plus any lenders in the room. What if you have a property that only, let's say it's a couple of acres and only part of it is in a flood zone? Whether or not they're gonna require it, I've always heard that it's kind of up to the lender. So. what are your thoughts
Sometimes
on
up to the, I think the title kind of helps decide that if there's no building on that area. So you get a piece of property and there's a little corner that's flood zone area. Then with, Google imaging, we're showing that there's no buildings there. It's not my call. It would be lender and title's call of, can we get a clause on that? Yeah. So,
I think, Caitlin, you and I have had a situation where we had a small corner of a building at the back of a property
Yeah,
that was in a flood zone, but the house was up on a hill. But this little barn that was
like a
falling down,
garage,
yeah, in the
yeah.
back that was of no interest to them to start with, which doesn't matter, right?
Yeah,
Was in a flood zone and it killed our deal.
yeah.
Not because of either of us, but because the buyer
It was just
Didn't want
skyrocketed
the
the,
insurance.
yeah, the monthly,
Yeah.
then they couldn't qualify anymore.
Yeah,
mhm.
Yeah.
So knowing that ahead of time
yeah.
is really great. The other thing that gives you a discount on your insurance is if it's quoted in advance. So don't wait until like the lender's office says, okay, we're ready for insurance, because often it's too late, especially if there's a problem like there's flood insurance, or if, Matt had said, yeah, this is gonna run, $100 a month, but because of all of these other variables, such as wood siding, a swimming pool, a trampoline, a dog, and a couple kids, it's now $150. It doesn't give us enough time to find a better solution for that. Plus, they lose that advance quote discount. And an advance quote discount can be up to like, if it's 3 weeks, you're getting a better price on the home insurance than leaving it to when, the lender's office says we're ready for insurance. And the reason why is because the insurance carriers know that you're shopping around. So they give a discount if it's quoted in advance. If it's quoted that we need the insurance tomorrow, if it's a cash deal, they're not getting the best price.
Well, also in advance, Brenda, Tara, you had a house that you were showing that we did a pricing scenario on before you even went to show the house. And I started looking at the pictures and called Brenda and said, Brenda, this is kind of an older house and it's huge. And it looks like they're using coal to heat a sauna or something in this house. Maybe we should find out what the homeowner's insurance is even before you take the time to go show the house. And we were going full circle even at that point. I know you showed the house, but it was like a $600 a month policy or something in the end. That was crazy.
And it was crazy because they had done all these build-ons onto the house and it was huge house.
Yeah.
Well, insurance is based on replacement value, based on square footage. And it was like, yes, the home wasn't maybe worth that much at that point. It would have been a great home. Is it still on the market?
I have
I
no
know
idea.
it would have been a great home if somebody had had boatloads of money to drop into it and then turn it into a nice, bed and breakfast. But
they also had 3 different materials on the roof. So one part of the roof was slate, one was shingle, there was a metal barn.
But could you imagine if we would have got far, and I mean, we weren't even to the point of putting an offer. But, looking at all of these things.
It also didn't
For the
tell us
whole
what the
thing.
electricity was
Yeah.
on it, so we were thinking, let's see here, and it was like an 1850 home, and it was just gonna be, and they were gonna be tight anyway, so their own credit jacked the price up as well, so it just wasn't maybe the right fit for them. It could have been a great house, somebody with very deep pockets. Yeah, so. Yeah, it was kind of in that area, it's a LeBron house. So those are the things that impact insurance. It's not one size fits all. Yeah,
What about like a boiler or
yeah, we
like
just,
oil heat?
yeah, that's fine. We just document it. So they'll ask us, what is the heat source? Is it natural gas? Is it hot water, steam? Some of your older homes are hot water, steam. They might say, okay, so when was the last time that was replaced? So we might need that detail. When somebody has like oil or propane, they want to know, where is that tank located? Let's hope it's outside of the Humvee and not in the basement. So, yeah, we have
They're
to,
always in the basement.
we are all in the basement, so,
That's funny she said that, because I used to do HVAC work, and actually, there's a couple in Canton that was over 100 years old. Boilers,
Really?
They're usually
Yeah.
really old.
yeah.
yeah, they last all of us.
Yeah, they wanna know when it was serviced and, yeah. So,
What about condo insurance? Is it different?
oh,
Is
yeah,
it more expensive?
no, it's less expensive, so condo insurance is great to write, and it's really wonderful for that first time home buyer that maybe doesn't have like super great credit, because the insurance is lower because you're not covering the roof, you're not covering the outside of the building. So it's walls in is the insurance. And really difference in price, well, we just went through one. Condo insurance would have been $700 for the year. When it's written as a home insurance, you're looking at $1,400. So condo insurance is great. Our rule at Goosehead is, and we have to stick with this, is we have to put the value from walls in at $100 per square foot. So if it is 1,500 square foot condo, we have to put our insurance dwelling coverage at 150,000 to have it replaced, so.
So what if the bylaws say that the owner is responsible for the exterior? So would that just be like a normal policy then?
Then it's a homeowner's policy, even if it's a condo, if there's not that bylaw that says, hey, we're taking care of the roof, the exterior walls, the landscaping, then it's a home policy.
Okay.
What else?
Okay.
Yeah,
What? Can you give me 3 tips as a consumer to save money that we may not know about?
to save money on your insurance?
Yeah, there's always those secret questions of, I think of lender world where there's all these overlays, right? So what would you suggest would save us money that we may not already know when shopping for insurance?
So, to clarify, are you asking while you're showing it to a client or for your own personal?
For own personal, or even for our buyers, when they're calling to get quotes of which insurance company to use. This one quoted really cheap, sure, but what does the coverage look like, etc. Any tips you can give?
Well, this little sheet helps, kind of the location of the house, the age of the roof, claims, your credit score. Deductibles, so deductibles is a variable that the consumer can control. So if they go with like the standard $1,000 deductible, their insurance premium for the year is going to be a little higher. If they can afford a $5,000 deductible, then they're paying less monthly. However, what happens is that client that you have that's close to debt to income ratio, if there was a claim, might not have that $5,000 available that they have to pay first to get something repaired, let's say their roof. So it's an iffy thing of what's really best for the client. If someone says, yeah, I've always got an extra 250, $2,500 in my savings account. If I had to make a claim, I can do that. The person that is truly paycheck to paycheck, why put them in that situation of they don't have to
So
$2,500?
if you've got money in the bank, then go for the higher
Yeah.
deductible.
Mhm.
What is the savings difference though, like 20 bucks, 100 bucks?
Well, sometimes it depends upon what the lender says to say, yeah, I need to bed that side of the room. I needed under $100 a month for the insurance. So we need the policy at $1,200. Maybe moving it from 5,000 to 1,000 gets them that so that they can close. It,
Do
yeah.
you hold the credit as an insurance company or are you taking it from what lender?
No,
said?
I never hear, that's not my lane, and I don't ever get involved in that. I might say, so I've worked a lot with Lisa. That's how I met Caitlin, because I said, you know what? I'm insuring all of Caitlin's people here, and they didn't even know that. So that's not my lane. So I will say, I might send Lisa a quick message to say, hey, insurance is coming back at let's say $1,200 a year, so I know I'm $100 a month. Is that going to work for the loan? Thumbs up, thumbs down. Because I don't want to have to then go to the client, go through all of the insurance, talk about this number, then send it over to a lender and they go, that's not gonna work. So if I can communicate with the lender first, before I have the final conversation with the client, we know it's going to work. If they say, not a problem, or I need it, $5 less a month for that loan to go through, then I can go back to the quote, increase the deductible, say to the client, this is why I quoted it at this number,
Sometimes it's not always best to bundle, right? Sometimes Progressive is great on cars and you can get cheaper home elsewhere, is that correct?
Bundles don't work for every property. So, Progressive Auto is fabulous. But they're more selective with their home and I could get their home cheaper somewhere else. But other carriers will say to us, so I write Foremost insurance for a lot of homes that I know that Progressive's not gonna take. Foremost will give the client a discount if they have their auto with our agency. So if they have their auto with Goosehead, okay, with a different carrier, they're gonna save $60 a year, which is $5 a month, which can really make or break the loan. So many of my carriers that don't write auto will give us a discount if our company overall has the auto. So if I can quote them out both and say, hey, we're able to save this on the home if we do the auto. If they're in a situation where their auto is cheaper, I am the first one to say, stick with it, just stay with what you've got. There's a lot of business out there. I'm not gonna schmooze anybody like that and say, let's come back in a year's time when your auto's up for renewal and see if we've got a better rate for you. Like if they've got a
Look at it like every year, right? Because they change pretty
Every year.
drastically and you don't even realize. that
You don't.
insurance
People
went up.
should look at their insurance every couple of years. Yeah.
Yeah, they've definitely went up. I've changed car insurances 3 times. Cause every year, for whatever reason, they claim inflation, so yeah, I've had to.
Well, that happens. Yeah. However, you get better discounts if you stay with some companies for a length of time because
longevity and loyalty is big with the carriers as well. So if I'm quoting someone out and they've been with State Farm for 15 years, my other carriers are saying, wow, this is a client that we would like in our book of business as well. So that's why I have to ask it also pulls, when we pull the numbers, how long they've been with a
I think in
particular
our
insurance
industry,
company.
there's like loans that you can get that have no down payment, no PMI, things like that, and people aren't aware of these discounts. So that's what I was hoping from you. Are there some discounts available that maybe we don't know about? or-
You know, advance quote is a good discount.
The
Putting
what quote?
advance quote, like quoting
Oh,
it 3
advance,
weeks
okay.
out, that makes a difference. Their own personal credit makes a difference.
Yeah, I didn't know that was a thing. That's pretty interesting.
If somebody's not paying the bill. Oh, so in our system, it will pull, if it's a husband and a wife or two married people, it will pull which one of them has the better credit. And that's the person we write insurance with.
Yes.
So even if they're not on the loan, but they're married, we might put the insurance with the spouse. And if it's a little high, I go, let me run those numbers again. The first named insured is the person that gets a better credit. And often what happens with other companies, our technology pulls that for us. With other companies, whoever calls in, they're running it on that person, but that person might not be the one with the best credit. Yeah, so
The opposite
we'll,
with lending,
we'll-
they always take the lower credit
I
score.
wish we had it that way.
Right.
yeah, so we'll play that around a little bit to say, okay, let me just run it with the spouse. Or if someone is not married and they're living together, we can't write them as married. Okay, I know that from the lenders, you can't ask that. Is that right, Matt? You can't ask if someone's married or not married?
You can ask if there's gonna be someone else joining, is it gonna be a joint or individual application?
Okay, and we have to ask that. Are you married or not married? Because they get a better rate if they're married. Doesn't matter if they're married, to a person of the opposite sex or the same sex, if they have a
Should both get married.
legal union.
Sure, anyone,
Um,
anyone.
Yeah. So what I will do is I'll say to a couple that's, engaged, I go, let me look at your auto after you're married. No sense me looking at your auto now. I'll look at your auto after you're married. You'll get a better rate. But don't put two people that aren't married on the same auto policy because stuff happens. And then it's really hard to separate them. So we don't write an auto policy as married if they're not married.
So Brenda, with that advanced quote that you were talking about too, a lot of times we'll get a clear to close early and everybody wants to move up the closing date. And if we make the insurance then move up and we had an advanced quote, that sometimes will affect that insurance amount and change.
They'll lose that
everything.
discount.
Hmm.
Yeah,
How
and
much
it's
is
a
that
numbers
discount?
game.
Like a range of that discount for the advance.
Sometimes to make or break a deal, $50?
A month?
No, overall.
Oh, okay,
Oh,
okay.
That's what I'm saying. That's a-
But sometimes with a loan, $50
Yeah.
makes a difference.
Somebody
That's-
doesn't wanna close a day early if it's gonna cost them $50 more
Yeah.
a year
Right.
sometimes, so.
Yeah.
Yeah.
Sometimes it changes it, sometimes it does not change it. So we kind of like a close number so that we know. I would rather it be, if you're gonna think you're closing on the Wednesday, we'll quote it for the Monday so that if it closes on the Tuesday, nothing changes. But you can't have it quoted for the Monday and decide to close on the Friday because then they're not insured, then we have to redo it and they lose the discount. So that's that. So married makes a difference for insurance. What else?
I have a quick question.
Yeah,
So, going back to who's holding the policy, does it make a difference if which spouse holds it? And I say this because, like with our medical insurance,
mhm,
we've found if a female holds the policy is always more expensive. Then, so Mike always holds our policy for that very reason. And I asked if it was like a situational thing, and they said, no, that's across the board. If a female holds the policy,
Yeah,
then it's always more expensive.
we're not like that. It just pulls credit. So
Okay.
it will come and say, hey, write auto with this spouse, write home with this spouse. And when it comes to insurance, if they're married, it's equal. Like sometimes I've had a situation where, maybe an older gentleman might say, why is my wife's name on this and I pay the bills? And I go, well, you're married. You both have the same, ability to make changes to your insurance. And then I find a nice way to say she had better credit than you did. And I go, she just came back with a better rate, and I leave it at that. I go, okay, and I go, you're saving money by doing it like this. But you can sign it. So yeah. So credit is big. So that's the thing. Insurance is necessary. It's always expensive. Every time the housing market increases in price, then at renewal, insurance will increase as well because it costs more to replace that home. So, any other question?
Yeah, okay, so, is there like an age period to where like the house is so old that it kind of narrows down like your selection of insurance policies?
No, that's based on discount. So, a home that is built in the 1800s is more expensive to insure. Then 1920 is a mark. So where we find this is with investors. So 1920 is a mark that if it was pre-1920, insurance is going to be a little bit more after 1920. So look, homes built in 1922. Then 1940 is another like benchmark. It's pre-1940. And then anything 1980s onwards is a different tier. And I don't know how much that is per month, but you just lose a discount. It's a percentage.
Yeah, I was gonna say, I had property years ago before I became a realtor, and it was 100 years old, and Foremost gave me a great rate, and USA and everybody else tried to shoot it like 3 times the price. That's why I was curious.
Yeah, and it just depends too what the insurance carrier is looking for at that time.
Okay.
It's not just, it's like, no, we have enough. And I've had some, especially some investment properties where a carrier that I've used many times, like a Steadily, says, no, we have already our quota in that zip code. And they won't take on another risk in case there was a major fire or tornado that went through a zip code. They say, no, at this particular time, in this 5-mile radius, we have enough business. So,
Do insurance companies see the property disclosures?
no. I don't know. I don't see it either, we don't. Unless there's a red flag and, like a fire had happened in the house, then we'll get all of the paperwork and we'll send that in. So,
Which they would have had a quote on. I was just thinking, you were talking about having a fire. I'm thinking, how do they ever know that, but if they file a claim?
well, if there wasn't a claim, we wouldn't know it, but if there was a claim, it is. So we have to pull reports all the time. So when somebody just calls in, like a random company and just gets a price, that person that they're talking to probably hasn't pulled the clue report yet, because it costs the agent money every time you do a clue report. So they often don't do that until they're ready to take payment, and then they go, oh yeah, by the way, it's a little bit more. So we always pull numbers before we talk to the client, or before I talk to the lender. So, and that's kind of insurance in a nutshell. It's, it's good. If anybody, we also do, like you said, we do flood, we do investment properties, condos, apartments, renters insurance. I do renters insurance. So any of my investors, I try to, say to them, hey, let me get the renters insurance for your tenants so that you know that you're properly insured. We also do jewelry insurance, and that can tack onto the homeowner's insurance if the mortgage is tight. We don't do that at closing or prior to closing, and we do that afterwards. And you can put a jewelry rider on your home insurance And that gets just rolled into part of your mortgage payment. So, right after holidays, we get some phone calls that say, hey, I need this piece of jewelry to be tacked onto my home insurance. And basically, something like that runs about $100 a year per $5,000 worth of jewelry. So, and that, you want that on there because it covers whether it's stolen or lost. So, but we would need an appraisal. So that's just part of what we add on to that. And sometimes it's part of the home insurance. Sometimes it's just a separate policy. We do a separate jewelry company so that, if you're talking to somebody when we're doing our discovery, say, do you have anything else that needs to be insured? Do you have any jewelry? Most women say, yeah, I wish. And then the man goes, no, she doesn't need anything. And then, they'll say, hey, yeah, I do have some jewelry. And occasionally we'll talk to somebody that's, wearing a $40,000 ring that's not insured. I'm like, why? This is gonna run you not very much money to get that.
I have one more, sorry.
Sorry.
Does a client need to specify that they need sewer backup insurance on their home insurance, not to assume that it already comes?
Okay, so water sewer backup coverage, we put it on every policy. If at Goosehead, as an agent, I don't put that on there, I have to document why. Okay, we're a pretty legal company, like we have to do a lot of sign-offs of client rejected it based on price. So with us, we're gonna put it on there and we're gonna ask how much is the basement finished? And based on that, we'll discuss what number that should be. If a basement is unfinished, then the base amount is $5,000 for water sewer backup. That basically covers for a company to come in and clean up the sewage that the city backed up into their home, okay? If the basement's finished, it goes in $5,000 increments, 10,000, 15,000, and it runs roughly $75 for every $5,000 worth of coverage. That's kind of the ballpark. Sometimes lenders, certainly not legal, and not Matt, they don't do this, but they'll say, take water backup off so that we can get, this loan through and they can add it later. We hyperventilate for that, because the client can't do that until the policy is up for renewal. So they're living an entire year without water sewer backup. And then we put that onus on them saying, you need to call me to get that put back on. I have 1,000 clients, I can't call you. You're gonna have to remember to call me, but they don't.
Do all insurance companies automatically add that on, or does the client have to request it?
All good agents put that on, not everybody does.
I had a client that closed and literally a week later, the sewer backed up their whole entire finished, beautiful basement.
And they had no
And they
coverage.
had no coverage.
Shame.
And I didn't know that that was a thing, so of course I tell my husband like, wait, do we have sewer back, like we just finished our basement? And no, we didn't have it, we had to call and get it added on, and I just assumed it. was
And
already
often
there.
when we're talking to clients a year afterwards, and they say, oh, we finished the basement, and I go, let me check how much water backup coverage you have on that basement. So it's just the communication. Mhm.
Speaking of that, when you have stuff on, is there like a grace period to where it actually comes into effect? Like a certain stuff, I don't know, like metaphor, so I can't think exactly a good example, but. Like say, oh, I'll wait, and then something goes wrong, then I gotta wait like a month to actually claim it or something, what I'm talking about?
I do know what you're talking about, and it's a full year. So you can't, for water and sewer backup, you cannot add that after closing. You can only.
Well, no, I'm saying in general, just like you
Renewal.
add it. Like you add, you renew, you add it, and then say, I don't know, it's happened like a week prior, and you're like, well, let me add this now, and then a week later, we make a claim. Is that possible, or?
Murphy's Law, it happens, yeah, but you can't call and say, hey, I wanna add that and then make a claim. They'll say, you can add that at renewal. So when their insurance is up for renewal, and that avoids people, you know, doing that. Like the people that are in a car accident and they had a $1,500 deductible and then they call and say, I wanna lower my deductible to, yeah.
That's a good example, yeah.
You can't do that. The other thing that we also sell, and it's important, is an umbrella policy. Who knows what an umbrella policy is?
Heard of it.
For your
I've heard of
business?
it.
Like
Yeah,
in your
it's
business?
it's a separate policy and of insurance. And your auto limits and your home limits have to be at a certain level to qualify for this. So your home limits have to be at 500,000. And what that does is it protects the client if there was an accident and they were sued. And clients that have some assets should have an umbrella policy.
Like, we looked into this because being a real estate agent and someone would sue me, I said, well, we have errors and emissions insurance, and the insurance agent said,
Yeah.
that's funny. They're not gonna cover all of it, so if someone sues you, Ginger, they absolutely can, you should get an umbrella policy, and I'm thinking, is this really something I need, or are you trying to sell me something?
You know,
Liability protection.
yeah, it's important. They're not,
So.
how much are you paying? Cause usually it's $600 a year.
I pay about 8,
Okay, every
but I
other,
do a lot of rentals.
okay, so when we write an umbrella policy, so. There's a variety of people that I say, you need an umbrella policy. So if you have a teenage driver, you need an umbrella policy. The end, like,
Yeah.
it's not, if they're in an accident, it's when.
Yeah.
Okay, so Matt and I have a mutual friend, his child just, got his learner's permit, and I'm thinking, I know he has an umbrella, yes. He's protected. Somebody has a swimming pool with a diving board, you need an umbrella policy. Kids are over, they're roughhousing, somebody jumps off the diving board, breaks their neck. The family sues you, that $500,000, let's say that you have of your personal liability, gets used up very quickly, your umbrella policy then covers the rest. So $1 million to $2 million. Every time somebody owns a boat, you need an umbrella policy. If you were driving your boat, you were on the lake, and heaven forbid, you ran over a child on the lake that you can see, okay? You need that umbrella policy. So, an elderly parent that's driving that has assets should have an umbrella policy. Because what if they cause that accident because they shouldn't maybe be driving and then the person was severely injured and the person's family found out, oh, well, Mrs. McGillicuddy she's got some bucks, people are very sue happy, unfortunately, but an umbrella policy is something that we can put into place at any time. And anyone with all of those things, teenage driver, boat, swimming pool, assets, get an umbrella policy. So, and they run depending upon how many rental properties you have, because we have to document that. Because if you had a rental property and there was a terrible accident at the property and they felt that you were somehow responsible for it, their kids were partying on the patio balcony, it went through 5 kids were hurt. Your $500,000 in your liability coverage for that property will very soon disappear, and that's why you need that extra policy coverage. So don't mean to scare you on that point, but an umbrella policy is a good thing. With flood insurance, one last thing, if flood insurance is required by the lender, it can happen immediately, okay? If you're in another area and you want flood insurance, you have to wait 30 days. From the time the policy is quoted until it's paid, until the policy starts 30 days. So if the skies open up and it start raining really, really heavy, and the water's rising, you can't call your insurance agent and say, hey, I think I want that flood insurance. There's a 30-day grace period for that. In some of our companies, it's a 10-day grace period, but there's always a grace period of, it can't happen immediately.
I got another question. Is there certain like insurances that get discounts depending on like job descriptions, like ex-military, realtors, or like EMTs, anything like that?
It happens for your auto insurance.
Just auto.
Yeah, and it's not what, it determines driving patterns.
Yeah.
So your USAA is going to give you the discount for your military. But when I'm quoting auto, I always ask what they do. And a teacher is going to get a better rate on their auto than, let's say, somebody who works in the hospitality industry
Yeah.
at night. And it's because the teacher's car is parked for 6-8 hours in a parking lot and they're not driving. The person that is driving a sales job, their insurance is more, or the person that's driving shift work because they're driving home at night. There's more drunk drivers on the road. You don't see the deer. There's a greater chance of an accident. So we have to ask roughly how many miles do you drive and what do you do for work?
Yeah,
Yeah.
I work from home.
And
I
then,
drive at all.
and I say, it doesn't matter what you do, it just determines the driving
Yeah.
patterns, so.
So realtor's auto is through the roof.
So you work from home and you barely leave the house. That's what I say. Yep, I go out 5,000 miles.
Well, category is, it's a grouping, it's realtor, broker, insurance, like the word, it's just a grouping here, so, yeah. If you have other people in your car, driving them around, you should have an umbrella policy.
Yeah.
Mhm.
Like friends or family?
Clients.
Clients,
Oh,
yeah,
That's.
They get
that's
themselves there.
nice.
yeah.
Yeah, that's old school.
Old school, okay, now, whatever, so, anyways, thank you so much for your time.
Thank you.
All right,
I'll get you guys set up. You can take like a 2-minute break. And then next up is taxes.
Yay.
So
My
take a
card.
little break, get a coffee refill. I'm gonna get them set
Oh,
up
yeah.
here. All right, thank you so much.
Oh,
That was very informational.
All right, take some of the time we can. Good.
Thank you.
Here we go. Brenda, you've probably done stuff with their clients because we do a lot of work together. Oh, yeah. Oh, here we go. Slideshow.
I have to whisper some names.
Okay, you can just.
So Miss Lisa,
Yep,
didn't know you were
chapter,
gonna be
yep,
here.
yep.
So I didn't know either.
I looked at your,
Yesterday.
yeah, we're gonna scare
outline
everyone.
of- She's like,
Oh,
No, it's
I know.
gonna be good. I wanna be scared.
We'll keep it light.
No, it'll be good.
Warmed over.
Yeah.
I am scared.
Was on kind of the same case, so I'm sure there's some, I definitely.
Terry's back.
They're all going home.
I mean, obviously we have the one that I called you about, and show that, right, even. Yeah, I'm not sure, somebody, going through my head right now. Did you do Cody Krieger just recently, closed last week? No, okay, that was with them. Did you do Zach Tamsel's last week? Okay. So of my 3 closings last week, Zach closed, you did his Kyle, but Cody was my 3rd and you didn't do him, but that was with them. Okay, so I'm very clear. Yeah, who else?
We can talk to people.
Yeah.
The only thing I don't.
Oh, and if anyone says,
I don't know the answer.
why?
Yeah. I know, I
Realtors
can see that.
is you build relationships with the clients, with the relationship
Let me
person.
get back to you.
You're the transaction
Person,
Right.
this place I used to work,
Hey, Mike.
she would kind of yell at me, hey, it's an AK writing.
Oh, hey.
Thank you for the text message.
You're welcome. Hey, let's go on with, Shauna Design.
We're looking at a house.
Three, okay.
Yeah.
I left them a message yesterday telling my son.
Yeah.
So, and I didn't hear from them, so I wanted to catch up with you guys,
I
I'm
think
sure.
we got a little distracted because they found that house in like.
Right.
When they found it in the area,
Right.
really, it just really.
They're specific to certain school districts now.
Okay.
And it's, I have a phone number.
Oh, right.
So now.
It's gonna be limited to for.
Yeah, but, yeah, good inventory, you know, yes, that everybody wants to do for the holidays, right? So it's a really great time. And it's something, so, okay, I'll get all the info reset, we'll have it on your number.
Oh,
Everybody not have the.
Seems like that.
Yeah.
Okay, very. So then, I don't know if there's ever.
Yeah, it's totally neat to see.
If anybody, yes, yeah, break the barrier, she knows.
And I'm happy to be doing myself. We are getting another stuff with that show.
Yeah.
Right now.
I still don't have that email from Amber. So it's on my list to do today. I've got my thing like say back. My fingers. But I have it on my list, so I will.
Right. You're so much.
I saw your pictures.
Even.
Yeah, I'm gonna try.
They have like insurance with.
You guys can move to the middle, move those chairs to the middle if you want.
It's probably good here.
Good, okay, perfect. All right, we're gonna get started again. If you want to find your seats.
Yeah.
That's
actually really.
Yes.
Okay. Yes, yeah. Yes, we have, continuing ed. This is not, this is not, yeah. Those are like, in order to have a CE class, the instructor has to get it approved like through the state. And then they have to report everything to the state and like report the CE, so. We have,
Okay.
three, that we have, it's every 3 years that it's due. We have fair housing, oh my gosh, fair housing, ethics and law. So it's basically like, don't go to realtor jail. So, yeah.
And this is like,
Yeah.
you need to learn things.
Yeah, it's more so, you know, what we can and cannot do with our license. No, it's more so like license.
Oh, yes,
Yeah. But this is all extra, like,
Yeah.
all the CEs are, they're not, sometimes they're just not correct.
Right.
Like, this is the stuff that like, we want to know,
Yeah.
tax season is coming up.
Right.
Yeah, so. They are. All right, so, this is Beth Gerbrick
Yeah.
and Tyler. They're from Schulte and Company, which is a tax firm in CPA firm in Fair Lawn area. And they also do payroll services. Is that correct? Yes, payroll services. So if you have a team, you've got people on payroll, or anyone on payroll, like your admin, whatever. I know them because I've used them. They deal with all my questions that I send every other month. So we're gonna go over, our Beth and Tyler are gonna go over this awesome presentation. So thank you. Let's give it up for them. Thanks.
So we have some tax information that pertains to realtors, as well as some updates to some tax laws from One Big Beautiful Bill. This is our office in Fairlawn, Ohio. As she said, we are a full-service accounting firm. We provide bookkeeping, compilations, reviews, valuation, tax returns. We do tax planning, as well as some other things as well. We do have a payroll site through Rock Payroll that we have on site with us.
And what prompted the need maybe for talking about taxes today is there was a big, beautiful bill passed by Congress in July. And the question is always, what was in that bill? So the tax laws, basically, there was a big bill in 2017, referred to as the TCJA. And that had a lot of really significant different changes. When they passed this bill, it kind of made permanent a lot of things they set into place with that prior tax bill. Otherwise, things were we're gonna be running out. All the rules they made were to run out. So this bill made most of those laws permanent. So today, we wanted to talk about taxes and how they affect people working in realty. We're trying to keep it as an overview and nothing too deep or technical. And we're thinking of realtors that are in the 22 to 24% tax bracket. We're gonna try to cover all these things, which you'll probably wanna run out of the room right now, but it'll be an overview. And the thing about taxes is they are complex and there's a ton of rules and a ton of laws and they don't apply to everyone. But there are plenty of things that apply to what you're doing. So to start off with, one change that the tax law made was pertaining to tax brackets. And your tax brackets fit. If you look at the circles I made, you'll see that there's 12% tax bracket and then 22% tax bracket. That's a 10% increase. And then there's the 24% tax bracket and the 32%. And that's another 8% increase. So the majority of people many people making a decent living are gonna fall into the 22 to 24% tax bracket. And what they did for the law change was just increase the amount of dollars in each tax bracket. So you might stay in a tax bracket longer than you were a year ago. And to the extent that you cannot, to stay in the 12% tax bracket, you can see if you're single, that's an income of 48,000. So it doesn't take too long before you're into the 22% tax bracket. And then to bump out of the 24% tax bracket into 32% for a single person, it's at 197,000. And a married filing joint is 395,000 up to 501,000. So that's why perhaps a lot of people are going to fall into those brackets. So it's just a small change they made to put more dollars into each bracket. Then we get into what is the changes made, or what are the general rules about taxes. So your standard deduction was a big change in 2017, where there used to be exemptions and a standard deduction, and the standard deduction wasn't that large. Then when they made that tax rule in 2017, they got rid of exemptions and they made a large standard deduction. So for 2025, the standard deduction is 30,000 for married filing jointly, or 15,000 for singles, or 22,500 head of household. That's the amount you can subtract from your total income before you have to calculate your taxable income. And then there's itemized deductions. So you're either itemizing or taking the standard deduction. So your itemized deductions are generally, the main ones are taxes, interest, charitable contributions, and medical. Medical's a little harder to reach usually, but for the years before this tax bill, based on the last tax bill, you could only deduct $10,000 for your state and local taxes. So that really limited a lot of people, and many people ended up using the standard deduction and not being able to itemize. So now they made it up to 40,000. So that'd be your property taxes, your income taxes to state and local. Those added together, you can deduct up to $40,000. Of course, there's phase outs on almost every rule, but it's going to allow more people to itemize. So being that you'll be itemizing, possibly you need to keep good track of all the various expenses, all the charity, all the interest. Of course, you get statements on your interest, and you can look up your property taxes. But that's the main difference there. Then other things that are changing, charitable deductions, there is a complex rule that's gonna come into play in 2026. That involves a floor, that I'm not gonna really get into, but another thing is in 2026. If you do take the standard deduction, you'll be able to take $1,000 of charitable contributions. Another new rule they made that's interesting and different is car loan interest hasn't been deductible for a long time. But they made that if you buy a new car, you can deduct up to $10,000 of interest per year. And interestingly, that could be if you're itemizing or taking standard deduction. So that's gonna be something that if you buy a new car, you're going to get something from the dealer and something from the lender that you're gonna have to have in order to take that deduction. And then most of you here are a younger crowd, so senior deductions probably not gonna apply to most of you, but perhaps your parents or when you're 65 and older, there's gonna be a $6,000 additional deduction. So if you took the standard deduction, be another 6,000 per taxpayer. So if you're married, it could be up to 12,000. And there's of course a phase out on that. So if you have a lot of income, you may not get that much from it. But when they were talking about what they were gonna do, they were saying they're not gonna tax Social Security. But they found out through these legal rules of how tax laws work and Social Security works that they couldn't eliminate that. So this is their compromise to give $6,000 deduction. And then maybe some of you are parents, there's a child tax credit that's going up a little bit to $2,200 per child. It was $2,000. And then child care credit is when you're hiring daycare so that you can work. And that is increasing in 2026 by $450 per child. And the maximum will be $3,000. One other thing I'll touch on with people with kids or no kids is 529 plans. Those are when you invest in a 529 plan through a state program that you're setting aside income for education. That used to be for college education. It's going to be broadened out to be for K-12 school. It's going to be broader for what you can spend it on. And it's going to increase to $20,000 that you can withdraw per year. So if you have private schooling or you have college kids, you put the money in there. You want to do this early so the money can grow. You don't get a deduction from the government when you put the money in, but when it comes out later for education, all that growth from the investment is not taxable. One other thing that relates to school is scholarship granting organizations. And that is something the state of Ohio currently has. And you can get a $750 credit. You can give $750 and it's a complete tax credit on your Ohio return. So you'll see a lot of Catholic schools do this. They solicit to have taxpayers donate $750 and then you're getting that back from the state of Ohio. The US government's gonna start that up in 2027. So the other thing about those, I said Catholic schools do it a lot of private schools do it, but also some public schools have started up. I know Nordonia has an organization they started up. And the purpose of the money to the school is for them to give scholarships to students. So that's a good benefit that you can consider. Then what was terminated with this tax law that could apply to a lot of your clients or yourselves is clean energy credits. So they're all terminated after the end of 2025. So there was a big credit for solar, wind, and geothermal with the 30% tax credit, and that's going away. And then there was also an easy credit for home improvements like doors and windows that had a $600 credit for heat pumps, water heaters, biomass stoves with a $2,000 credit. Those, if there's any consideration of buying those, you should do it by December 31st because it's not going to be there after that. Another thing that has changed is gambling losses. So people that get 1099s from casinos have to report that income, and then they will try to itemize and take their losses against it. So they've changed it to where you're only going to be able to deduct 90%. So you're always going to have 10% of what they say you won, whether or not you lost a lot more, you're always going to have some tax there. And then health insurance, this is a big fight in Congress. The premium tax credit on health insurance, which I'll talk about health insurance a little later, there were enhanced credits that were expiring at the end of 2025. And so the expectation is that health insurance premiums are going to go up for a lot of people. But we'll talk about that a little later. And then as business people, you have deductions. So what is the qualified business income deduction? That is a tax deduction where self-employed individuals or owners of pass-through businesses deduct 20% of the qualified business income on their personal returns. So as a realtor, your net income is qualified business income. So if you made $100,000, when you're doing your tax return, 20% of that, 20,000 is deducted from your income before your taxes are calculated. Rental income, it depends because rental income can be considered passive income. Say if you have one rental house, that's probably passive income because you just collect the rent and maybe go over once in a while to see a problem. But if you have a more robust rental business, it can be active and you might be a real estate professional. If you have any number of rentals, you can meet the condition by maintaining separate records and performing at least 250 hours of rental services. We're going to talk about real estate professionals a little more later, so I'm going to move on from that. But the qualified business income deduction is staying in play, and it is a benefit to being in business.
Yeah, can you, excuse me, can you explain the qualified business income deduction a little more? So let's say you make 100,000.
Right.
Like the way that when we make 100,000, we have, a lot of things that come out. We have our split to the brokerage.
Right. Well, let's say you make 150,000 and you have 50,000 of expenses. So now you're down to 100,000.
Okay.
That's going to be taxable.
Okay.
It's your net income.
So that's like, if we find, and that's all of your write-offs and deductions after all of that, like
After all that.
your just actual profit number.
Right. Your
Okay.
actual net
Okay.
profit.
20% of that.
Yes.
Okay. Good to know.
Yes. Yep. Okay. So another thing that business people have is depreciation. And that is to say that you take the entire cost of capital assets and you write them off as business expenses. Depreciation is generally done over time. So what they had was bonus depreciation, and that was originally 100%, and every year it was going down, and it was down to going to be down 40%, and then off. And the new law made it 100% permanently. So that is for assets that have a life of 20 years or less in tax terms. So that is not real property. That is lesser things that are in a house or in a rental house or cars. And you can write that off in year one. And then section 179 is like a sister to that. You can expense something in year one. It doesn't really say it's depreciation. It's like a different pool, a different way of looking at it, but both are letting you write something off in year one. And there's a caveat to that because Ohio does not allow bonus depreciation. So you end up adding it back in Ohio and having to take it over 5 years. And then the big caveat on it is that recapture. So when you sell an asset, you will have to recapture the depreciation you took in year one up to the amount of the gain. So if you had an asset that cost 100,000 and you wrote it off in year one, you've saved a lot of money right there. Then 3 years later, you sell that for 50,000. Well, you wrote it off, so now your basis in that in tax terms is zero. So you made 50,000 at a zero basis. That's a $50,000 gain. And what the recapture does is say, well, that would have been a capital gain because you had it for 3 years, but recapture makes it be ordinary income. So generally subject to a higher tax rate. So you always have to watch out for recapture or consider it when you're making decisions. So with we're just like, oh my gosh,
Yeah, I'm lost.
making you're lost. Okay. All right. So let's say
We take
okay.
break.
Wait, let's say you have let's say you have a rental property and you buy something that's maybe not considered part of the actual real property. So
Like appliances.
Yeah, like a refrigerator.
like appliances. The thing with appliances is maybe the appliances cost the third part of it is you can use de minimis rules. So something that costs 2,500 or less, you can write off right away. And it is an expense and you don't have to worry about it anymore. Let's say it was something that cost $10,000. So you say, I want to take bonus depreciation on that. Right now, today, I'm going to write off $10,000 this year. And so you write it off, your income goes down. Then in say 2 years, somebody says, I would like to buy that $10,000 asset. And so you sell it to them for $10,000. You feel like it's still worth that, but you wrote it off. You took a $10,000 asset and in tax terms, your basis is zero because you already took it as an expense. You already reduced its value to zero in book terms. And so you're making a $10,000 profit. In your mind, you bought it for 10 and you sold it for 10, you don't have any profit. But really, you took advantage of reducing your income by 10,000 at that point in time. So when you sold it, you have a $10,000 gain because you've already used up your you've expensed it and on the books, it's sitting there at zero.
So
you
if like
have
the
it,
government paid you 10 grand for it, but you still have it.
right, and you're selling it to someone else, so you made a $10,000 gain.
So now you're paying the government again.
So now it comes back into your books.
You
And
can't
you're-
hold it.
So you're-
And you are not, you're like, well, if you hold an asset for more than 1 year, it falls into long-term capital gain, gets better tax rates. But you held it for 2 years, but because of this recapture rule, you're not getting the nice long-term capital gain rate, you're getting ordinary income rate. So even though you feel like cash in, cash out, zero, on the books you did cash in, tax benefit, and now cash out is a tax price. That makes sense.
Yeah.
Okay, so with the thought of recapture, so I already mentioned the de minimis rule where you can write things off that are 2,500 or less. The next thing is about vehicles. So people might like to buy a nice vehicle for their business. But you will be subject to recapture. And if you like to buy a vehicle every 2 years and then it's still got a great value, you're going to be paying back the benefit you took every 2 years. You're going to take a benefit, pay back a benefit. So we have the federal mileage rate is currently 70 cents a mile. So if you think about if you drive 10,000 business miles, that's $7,000 deduction. That might be more beneficial to you to just get that deduction each year based on your real miles versus buying a car, figuring out the business use percentage of it, and taking the big depreciation deduction. We find a lot of people that have businesses, maybe not realtors necessarily, but certain businesses, the guys who like to buy trucks always want to buy more trucks. And they're always losing the benefit of, and they always want to write it off, but they traded something in. So however much they gained on that other thing is coming back as income. So it's something to think about is what are you doing with your car? And if you would happen to have a hybrid or a electric, you're still getting 70 cents a mile. So that can be very beneficial. Yes.
So as agents, obviously we use our car all the time. Is it better to write off the mileage or like your gas? You know what I mean?
Right.
Like paying for the gas
Right.
or car,
Yeah,
car
you
payment
can-
or
yeah.
car repair.
Right. So you could take all your expenses and calculate the business miles versus the total miles. Take all those expenses at say 80% was for business use. It probably usually our software will calculate either way, but at 70 cents a mile, you may be better off. It works out pretty well to where when they do that with all expenses, they're taking into account even depreciation. And when they do the 70-cent rate per mile, they're taking into account depreciation in that a car goes down. It depreciates over time, clearly. So you can track, if you don't have a history on it, maybe track all your expenses and then ask the accountant to figure out which is better. But it's a good chance the 70 cents a mile is going to be just as good. Because it's supposed to take in, that's why it's gone up over time, is because gas prices have gone up, vehicle costs have gone up.
I think the last couple of years I did it, it was always faster for paying mileage instead of my payment,
Yeah.
insurance.
Yeah.
Same.
Right. Okay, so talking about depreciation, some of you sounded like you had rental properties. So what can qualify to get bonus depreciation is that things that are 20 years or less. So land improvements, sidewalks, landscaping, pools, permanent improvements that aren't attached to the house that are outside. And then qualified improvement property, that relates to commercial property, not residential properties. So that's interior improvements, say to this office building, but not to the rental house. The thing about residential rental properties is it's not as favored as commercial properties. So some of the breaks you get, including that residential properties are often passive income, are not as good as if it's commercial property, but I imagine most of you have rental properties are probably homes. And then appliances, furniture, tools, etc. can be written off, as we said, with bonus depreciation. And then just to clarify specifically, buildings and land are not eligible for bonus depreciation. If you have a residential real piece of real estate, it depreciates over 27.5 years. And in commercial, over 39 years. So if anyone is into commercial real estate, what's very popular now is to do cost segregation. It's not usually that beneficial to a home, but commercial property, especially if somebody, even if it's already built, but particularly with new builds, you have a professional break down the components of the build, so, and turn it into asset class lives that are less than 39 years. And it can save a lot of money. Okay, so since you're all doing excellent record keeping, like Caitlin does, I will say if you have struggled with what to do for your paperwork and tracking things throughout the year, I think Caitlin does a good job.
Thank you.
And I would definitely recommend, because one of your biggest expenses is going to be mileage. I would recommend using MileIQ or something like that, because having it recorded realistically is really important. And then there's a home office deduction. So if your main office is here in this building, and this is where you come all the time, you may not be eligible for the home office deduction. But if you do a lot of work at home, then you can get the home office deduction. So what we recommend doing, one way to do it is to track all your utilities, all your expenses, mortgage interest, insurance, everything like that. But what often works out just as well is to just take $5 per square foot. So you take your office, you should have a particular room that's used for the home office, square footage on that, and you also provide the home square footage. And you take that home office square footage at $5 up to 300 square feet. So that's like so the best you can do is a $1,500 deduction for your home office. But it works out pretty well, because you don't want to involve adding in your home as in depreciating it or anything like that. So you would really just have your utilities, interest, insurance, costs. And so $5 square foot is pretty fair, and it's way simpler. Okay, if you have assistants, if you have people that work for you or help you, if they're not on payroll, you probably need to give them a 1099. If you pay them over $600 a year, then you're supposed to give them a 1099. And in the starting in 26, it's going to go to $2,000 is what you need to do for a 1099. And then if you have someone working for you super regularly, there are definitions of what needs to be a payroll person versus a 1099 employee. So they have to have a little bit of independence from you to be a 1099 versus a payroll. But that's another long subject we won't dig into. You have a
Go
question?
ahead. I think you're gonna cover it and then.
Okay.
You're good.
Okay, so then, what else can you deduct as a realtor or any kind of business person? Everything. Every realtor wants to deduct everything. So you have to bear in mind, your personal life is separate from your work life. And the best thing I can say again is track it as you go. Like if you can use Excel or numbers or something to track as you go, it's gonna be way better than thinking, oh, I gotta make an appointment with my accountant. I wonder what I can put on my list. Do it as you go. So of course, you obviously have professional fees, licenses, fees, dues, education and training, marketing and advertising, obviously the mileage, the home business, the assistance, technology and supplies. So if you buy a new laptop, you know, if it's under $2,500, you can write that off in full right away. If you buy a new cell phone, if you buy, so cell phones are definitely a business expense. And even if you have the same phone for your personal, generally you can write off the full monthly cost or the cost of purchasing it. Because you wouldn't be able to be in the business if you didn't have a cell phone. So it's basically, what do I need to be in business is a real good expense. And then business meals and client gifts. So business meals are only deductible to 50%. And you need to have a reason for the business meal. So the suggestion is to like get the receipt and write on it right away, the person you met with and what was the purpose. And, you know, keep them all. You could post them on a spindle or something. And also, I personally like spreadsheets, so, you know, you can add them as you go.
Are you saying all my Starbucks runs in between showings are not a write-off?
Well, probably not, but I would say probably people turn them in that way for sure. And, you know, I mean,
She knows.
I
too
guess
much.
there's a lot of coffee drinking in Realty, I'm sure.
Actually, I was just bringing my Starbucks to my client, I was meeting with.
Yeah, there you go. Exactly.
So it's,
You always get two.
their copy is written off.
Theirs is written off. Mine is not supposed to be written off. Theirs is supposed to be written off, exactly. And then client gifts actually are limited to $25, which is pretty low, I realize, but I know you frequently get people gifts.
We get around it.
Yeah, we try. So do people bend the rules or whatever? Yes, I'm sure. But these are the rules as they come out. So
Could you take that $25 client gift and divide that, like multiply that by 12?
yeah.
Yeah, so you're.
Give
really-
12 people
Or no, you're
or
giving a gift like
every month. You give it
every
to them a
month,
month.
but you just happen to see them one time a year.
Ah, uh-huh.
Yeah.
I mean, there's logic there, I guess.
The way that we get around it a lot is
email math.
put
Yeah.
your, you know, put your logo on
Right,
something
and
and it's
then it's
advertising.
promotion.
So like, that's what a lot of people
Right,
will do.
right,
So.
yeah,
Because that's 100%.
Like
Yeah.
25, a couple, I can consider I gave her 25,
I
I
guess
gave
so.
him 25,
Okay.
right, so. it's
all right,
actually
I'll buy that, sure.
Not that I've learned these things.
Well, yeah, I would say, your accountant needs to know all the rules. And they're not the auditor of the IRS though, so. You know, you might not get away with something with the auditor that you would get, your accountant would be like, okay, well, you'll have to prove that later, kind of thing.
I try all the time, my tax guy's like, no.
Right. Right,
I
yeah,
have a question about the 1099s
Yeah.
and who qualifies for
Yeah.
a 1099.
right,
So obviously, if you have like a marketing assistant or this is my showing assistant or whatever. What about like, I pay a girl to clean my listings, but it's like I Venmo her every time, and then over the year, it's more than $600, and you see these Venmo transfers.
yeah,
I know Venmo you love, but
yeah, well, and you gotta consider that the digital world tracks everything already. So, so that person who's cleaning for you,
Right.
I mean, she might be cleaning for 12 people. So
Mhm.
she's definitely not your employee. So she's definitely a 1099, and if you paid her over $600 in the year, yes, she needs a 1099.
Unless she has her business set up
As
differently.
well, if she is an S corp, you don't have to give 1099s to businesses. It's for individuals.
Okay.
And if a person is an S corp, then they are a business. But for instance, partnerships are actually not exempt from 1099s. It's a lot of little rules, but yeah, so maybe it'll be good that it goes up to 2,000, be helpful. And also the person who did all that cleaning, whether she got a 1099 or not, she is supposed to self-report all her income. So it's not like, oh, I'm doing all this under the table. I mean, she is technically supposed to be reporting her income. The 1099 just throws the clue to the government, like, this person's making
Is
money.
it more advantageous to me to give her a 1099 or just let it be an expense?
Well, yes, it's more advantageous to you in the sense that it's required and there are penalties if you don't. But it's still an expense either way.
Okay.
I mean, there's proof that you paid her, so that's the proof it's an expense.
Okay.
Yeah.
Which is good for Caitlin, right? Because she can write it off, but
Right.
the housekeeper.
Just
not
Now
so
it's like
much.
I
Not-
reported
not
below.
loving it.
Yeah,
Yeah.
so you should probably have a conversation with the other party.
Yeah.
And be like, do you wanna make 599 or do you wanna?
Exactly. I'm just making $1 less. Don't be offended.
Yeah.
Yeah.
Right, and yeah, but as far as Caitlin, I mean, she can still write it off whether she gave 1099 or not, because she did pay the money.
Sure.
So it's just a obligation to file that form, I guess.
The 1099 is a deduction, the same though, right? Is
Yeah. Right,
just deducting it yourself as an expense, right?
yeah, you're deducting it as an expense, and I'm just saying, you can deduct it as expense even if you didn't give the 1099. You just like not complied with the government rules for reporting.
Deductions.
Yeah,
Before we move on to the
Yep.
next one, I apologize.
yep, no, good.
Every year when I get my taxes done, my accountant always tells me that I don't spend enough in marketing and advertising. Because I'm always trying to keep those expenses low, and he, of course, can't tell me what other agency does, but just says, you know, their marketing and advertising are way more than yours. Is there a percentage? 20% of my income, is there some kind of guideline?
Not really, but there's probably guidelines out there. There's nothing, no, I think he's indicating that, well, most people have a lot more than that.
Right.
But no, there's probably something that tracks that, but the government doesn't use anything.
I think Gary
particular.
Keller, like, if you read the Millionaire Real Estate, I think he says 30% total expenses. I don't think that's just
Yeah.
marketing,
That makes sense as
but
far.
check with Brecht, because we just learned this at the ALC.
I'm trying to come up with as many deductions as I can, I'm like, we deducted that, I don't have anything else to deduct.
You might just spend less and you're more financially sound. than
I am
the
more
others.
frugal.
Right.
Yeah, but there's nothing wrong.
Right, I mean, you're.
I'm
There's
already
nothing
says
wrong with
plan
that.
for 30%.
Yeah.
Like plan for 30%, if you do less, then
Right,
It's
I would
less.
say 30%, yeah, I would say realtors don't have the most expenses relative to the income. You know, but I would say 30% might be a thought that's common at the bottom line from the. You know, all the expenses together. Could be that. So briefly on health insurance, that's a deduction if you're paying for your own health insurance And that's fully deductible, not on your business portion, it's deductible on the front page of your return, more or less. So if you're on the health, if you're on the marketplace, any insurance you have for health insurance, you're gonna get a 1095 A, B, or C. A comes from the marketplace and it reconciles what you paid versus what you could have had to pay if you didn't get any discounts when you applied for your insurance. So if you apply for your marketplace insurance and you say you're gonna make $50,000 and then you make $100,000. And when you said $50,000, they gave you a nice discount on your monthly premium. Well, at the end of the year on the tax return, you have to pay back that discount. So that's a little whammy that people sometimes get. So it's not wise to under-report to your insurance salesperson. You know, you can't always know. You might have a great year and you hadn't had any great years before that. But it is something that comes back around at tax time. And then one of the greatest, oh yeah,
So opposite of that,
yeah,
let's say you had a really good year last year, so you
Yeah.
over budgeted, and then
Right.
this year you're not doing so hot.
yeah,
Whenever your taxes come, would you have?
yes,
Some
you
sort of
can get
people-
it back. You can get a deduct, you can get the prepaid overpayment can come back to you after they calculate, yes. You can. So, yeah, so it's tricky a little bit to know what to put out there when you're buying insurance. And then the health savings account is one of the greatest investments you can make as far as savings. And that goes with a high deductible health plan. Because it's triple benefit. You have tax deductible contributions, so whatever you put into it is not taxable income. It's growing tax deferred, and then it comes out tax free. So like with a IRA, when it comes out, it's taxable. But the health savings account is to be used for medical, of course, but when it comes out, it's tax free. So as soon as you set that money aside, you're getting a triple benefit. And the amount that you can contribute is $4,300. And that's for single coverage. If it's family coverage, it's $8,550. And if you're over 55, there's another $1,000 that you can contribute. So I would highly recommend it, and especially if you're pretty healthy, get the high deductible health plan, and start sinking some money into that HSA, and it goes your whole life. And so it can, and once you put it in a health savings account and you get a certain amount in there, they have an investment vehicle in it. So it's not just sitting there at some low, no growth. There is, same as the IRA, there's investments that you can put it into. And then if you would be in a faith-based health sharing plan, that's not deductible. It's not a qualified plan, and it doesn't get you any kind of deduction. It's generally cheaper, but you don't get any tax benefit. Okay, this is a scary little page that's not going to get into too much, except to say you could check it out. That's about retirement plans. So if you can set aside money each year, there's different vehicles that you can do it with. There's solo 401k, SEP IRA, simple IRA, traditional or Roth IRA. And the best thing to do is to talk to a investment professional and kind of figure out what's your picture, your whole story, and then figure out what you can do. The very simplest thing to do is the IRA. So if you're younger, most people recommend the Roth IRA. You're putting the money in, you don't get any tax break when you put it in, but it grows. And the however much it grows, when you take it out in retirement, it's not taxable. And not only that, it doesn't have a required minimum distribution that IRAs have. So you can have all this money, you don't need it, you can save it, and your kids inherit it, or you take it out and it's, let's say you put in 7,500 and 30 years from now, that could be 50,000 maybe. Whenever you need it and take it out, it's not taxable. With a traditional IRA, if your income meets, so there's income limits to it, to be deductible and you meet the income parameters, then you're getting the deduction today on your tax return and it's growing. But when you take it out, you have to pay taxes on how much it grew. And you have to take it out with required minimum distributions, which is going up to age 75, starting at age 75, you will have to take out, say, it's like 4 or 5% a year and it grows. And so every year you take it out in retirement, it's taxable. And most of you aren't even close to that, but I will say a lot of retired people have almost as much income as they had back in the day because they have these big retirement accounts and they have to take it out and they have to pay taxes on it. So I'm not a investment advisor, but if you're younger, the Roth is usually the way to go.
Can I stop you again for a second? Sorry.
Yeah.
Can we go back to the HSA quick? HSA has become a huge way to save money.
Yeah.
And you're right, 100%, all of these extra positive things about it.
Yeah.
Is it true that you cannot pull your money out of an HSA for 20 years? Like if you're using it as a savings or retirement account?
Oh, well, when you have an HSA, you can take it out. You can put in this year and take it out this year to cover the costs of your medical care.
But if you're not using it for medical care, that's.
Yeah, so when it's not used for medical care and you just built up this big account, then if you, I don't have the exact rules in front of me, but yes, if you pull it out, even today, if you pull it out and you just had to have some money, it's gonna be taxable with a 10% penalty. And then is there a 20-year rule? I don't know about that, but there is rules that if you're under 59 and a half, with most retirement accounts, you're gonna pay a penalty when you take it out. In addition to income tax, you're gonna pay a penalty. So.
It goes in tax-free, it comes out tax-free, it can build, like, there's great things
Yeah.
about it.
Yeah, and you should definitely be wanting to think of it for medical purposes.
Sure.
And yeah, when perhaps, let's say you had a baby or something, I mean, that would be a nice thing to have tax deductible money. You can put it in the same year that you have to take it out for a medical purpose and you're still getting that tax deduction. And if you don't have any health concerns and you get old, then when you take it out, I'll have to dig into that for a good answer.
I just talked to
What
my
happens when you
financial
don't use it?
advisor
Yeah.
yesterday about this,
Yeah.
as to how much to put into my HSA.
Yeah.
He said, max it out, put
Yeah.
all your money into your HSA, that 8,550. He says, because you're good to use it for your medical expenses as much as you want, tax-free.
Right.
When I reach age 65, I can then use it for expenses that are not medical related, but I'll be taxed on it, but there's no penalty.
Okay, there you
And
go.
it's just growing over
Yes.
those years.
65, I agree, I think that's what it is.
What is the tax penalty on that?
10%.
10%?
Before age 65.
If you're over 65.
If you're over
Oh.
65, there was
No.
no penalty.
Oh, but the penalty, if you were to put it in and take it out for something besides a medical expense, you're paying income tax on it because you hadn't before. cause you got it in there tax-free. And there's a 10% penalty. And it keeps giving you a 10% penalty till you get it repaid in there, so. Yeah, you definitely don't wanna. Use it for the wrong purpose, or if you don't, yeah, if it's not gonna work out for you, don't start it up, but. To the extent that you, can keep it year to year to year, cause there's what's called the FSA. Where you put money in as you go along, but you gotta spend it in that very year. This grows indefinitely,
So
yeah,
I have health insurance because my husband works at AT&T. But if, can you put that in there and use it for your deductible?
Yeah, make your monthly premiums.
you can. Not use it for your deductible,
So
but.
just to pay,
Well, we use it for the deductible.
But I mean, cannot use it for your premiums, you can use it for your deductible, yes, I meant premiums, sorry. You can't use it to pay the premiums, but yeah, your deductible, it's gonna come to you in a medical bill. And they're gonna be like, you owe $500, and so you pay it with your HSA, which usually you have an HSA card, like a credit card. So you can give that at the doctor's office or the pharmacy or the.
Which is a win-win, cause it.
Right. Right,
And
so,
these HSAs are huge now, everyone's
Yeah.
really.
they're definitely, like, if you have only. Say you have $4,300, should you do an IRA or HSA? Probably an HSA unless you, don't think you ever have any medical concerns whatsoever.
Because that money's growing tax-free, right, as it's.
Yeah,
sitting in-
and it's growing, but when you're in the HSA, say health equity is a big one. Like you have to go in there and put the money into their investment vehicles. And otherwise it just sits there. If you don't invest it within the HSA provider you have, it's not gonna grow. So you gotta get a little cushion in there and invest. So that.
move it around like you're doing a stock.
Yeah, like they'll put it in mutual funds for you. And then if you got to need it, they'll pull it out and you use it.
When you say they pull it out.
Well, when you ask them for the money,
Oh,
they'd
okay.
have to get it out of your investment portion and give it to you. So the growth comes when you don't use it and you use their investment, mutual funds or whatever to grow it. So you definitely gotta go in your HSA and look at it, is
So-
one thing,
If you have an HSA,
yeah,
could you use it towards dental expenses then?
Yes.
If you didn't have dental insurance or
right,
your eyeglasses,
Yeah.
if you did not have eyeglasses.
Right.
Yeah, you can buy
Right.
over the counter stuff at
Yeah.
Walmart with it.
right, you can buy your over the counter.
Contract
Yeah, it's pretty
solution.
broad medical
Vitamins?
use.
Yeah, anything,
Right?
yeah, there's a whole list.
But even if you don't end up being able to grow it because you always have medical expenses, you're lowering your taxable income the day you put it in there. Even if you pull it out tomorrow. Okay, all right, Tyler's gonna speak.
Capital gains on personal residence real estate sales. So under code section 121, if you're single, you'll pay no capital gains on the first $250,000 of profit over your basis in that home. And that jumps to 500,000 if you're married filing joint. You cannot claim the exclusion more than once in a 2-year period. And there's 2 tests you have to meet. It's an ownership and a use test. So you're eligible for this exclusion if you own and use the home as the main home for the period aggregating at least 2 out of the last 5 years prior to the date of sale. Generally, you're not eligible for the exclusion if you excluded the gain from the sale of another home during the 2-year period to the sale of your home. And then if you receive informational income reporting documents like a 1099-S, which is the proceeds from real estate transactions, you have to report the sale of the home even if the gain is excludable. And then publication 523 is a great resource to lay out all the rules and the worksheet for selling your home.
Do you want to? Example of that.
Okay,
Okay, oh,
Yeah, it's on.
yeah, my bad.
Yeah.
Sorry.
Converting a rental to a personal residence. This is a good tool to potentially set up that capital gain exclusion in the future that we just talked about. The capital gains exclusion is prorated for rental periods, and you cannot exclude gain attributable to periods the home was not your primary residence. Any depreciation deductions you took while the property was a rental must be repaid or recaptured, as we talked about earlier, recapturing as a tax, even if you later live in the property. And then if the property sells for a loss, that loss is no longer deductible because it's considered a personal use property. And then doing this triggers a shift in what you can deduct as expenses. When it was a rental, you can deduct things like homeowner insurance, repairs, maintenance. But when it's a personal residence, you lose those and you can only deduct things like real estate taxes, mortgage interest, and those will be itemized deductions. An example. So these are married taxpayers, K and M, great names. They buy a home in January of 2021 for $310,000. They've used it as their personal residence until they move out in January of 2024. On December 31st, 2025, they sell the property for $510,000. The entire $200,000 gain on that sale qualifies for that exclusion because they owned and used the home as a principal residence for the last 2 out of 5 years, or at least 2 out of the last 5 years, my bad. Yes.
What about selling a rental, selling a home that is not your primary residence? Do you pay, if you're gonna, okay.
No, go ahead. No, go. Yeah.
If you're gonna sell a rental, you've never lived in it, it's always been used as a rental. What capital gains rules are there with that scenario?
Well, so if it wasn't a personal residence and you made that 200,000, you never lived in it, it was just your rental property. So then you have a $200,000 gain that you'll be paying tax on. And as long as you've held it more than a year, it's gonna be a long-term capital gain. There is a little rule in there about recapture, but we won't really get into it. So you want to get long-term capital gains, which are rated at 0, depending on your income, 15%, the majority of people, 20%, some people. And then if there is recapture, that can be 25%. So that's a little complicated. And so your rental property probably took depreciation on it over the years. And so that's when that recapture might come into play. But it's complicated.
Is there a significant difference if you've owned this rental for 5 years versus 25 years? Or is it always gonna be like that 15%, taking 15% capital gains?
The percent, so the 5-year or 20-year doesn't matter, it's like more than 1 year.
Okay.
Is all gonna be the same. The 15% or 20% depends on what your full income is.
Okay.
And that's what decides what rate you're in. So it's kind of like those, what I showed at the beginning, the tax brackets. So for capital gains, there's just 3 tax brackets and it's based on your total income, not what that particular property was.
Okay. Thank you.
You can defer gains using a 1031 exchange. This is, if you've heard of it, it's also called a like-kind exchange. So when you exchange real property used for business or investment for other business or investment property that is the same type, also known as like-kind. Generally, there's no gain or loss recognized under Code Section 1031. This only applies to real property, so that's land and anything attached to it, and not personal or intangible property. There's a couple requirements for this. There's a 45-day rule. You must identify a potential replacement property within 45 days of selling the property. And you need an intermediary to hold the cash or it spoils the 1031 treatment. So you can't touch the cash if you sell a property or it ruins the 1031 exchange. And then the 180-day rule is you must close on the replacement property within 180 days of selling the first property. Gains are deferred, they're not eliminated.
Hold on.
Yeah, hold on, that's a good one. That's a good one.
Okay. As a real estate agent, I've watched many investors use 1031 exchanges.
Okay,
But what I cannot wrap my brain around, and explain this to me if maybe I don't understand it correctly. If I buy a property, I fix it up and I go to resell it. I'm trying to get out from capital gains, right? So I defer having to pay capital gains and I buy another property.
Mhm.
I fix it up, I resell it, I defer. But what I can't understand is as you keep deferring, you have to be of equal or more. So why would I not pay capital gains on the cheaper property and wait, instead of waiting until I get to the $500,000 property that I am now paying capital gains on? What am I missing?
yeah, it's just, you are kicking the can down the road, as we like to say.
But I would pay
So-
more with the more expensive property, right?
Well,
Instead
I
of
mean,
the
if you
100.
end up, sure, because every time you defer the gain, you're more or less lowering the basis of the next property. So then you sell that for a gain itself, but you have the other gain too, so you have a much bigger gain, and yes, you would be in a higher tax bracket, but I think the people that do them the most have so many things they're investing in that like they're either gonna keep going with that until they're not on this earth anymore and
Wow.
it's inherited and then the basis steps up. So when people die, their inheritors inherit at the fair market value. So that gain kind of disappears, or they're in so many things that they've got gains here and losses here and
Just
they
even
can
out.
sort of wash them against each other.
So I have a quick
Wow.
question.
Yeah.
So I had a condo in Myrtle. I sold that. I did a 1031 and I bought a house in Pigeon Forge. And I've now had this house in Pigeon Forge for 2 years. Now I want to sell this house in Pigeon Forge and buy a 12-unit apartment complex.
She can just keep going, right?
Yeah, you
So I
might
can't-
keep going.
Is it like enough though? Like a like?
Oh, it's way more. The 12 units way more than the Pigeon Forge, so.
No, I
that's-
meant like,
Like
can
the
you go
type
from
of
a
property.
to a 12 unit
Yeah, I think it
commercial?
would be, I think it would be
Oh,
okay. You
Okay.
mean because of a house and then a
Yeah.
multi-unit?
Oh,
I
wow.
think that's okay.
But the house is still a rental property, right?
Yeah, her pigeon.
So my
Forge was-
Pigeon Forge
yeah.
is short-term Airbnb. So I wanna sell, so I sold the condo Airbnb, bought the Pigeon Forge Airbnb, now I wanna sell that Pigeon Forge Airbnb and buy a
Multi-family.
multi-family
Right.
12 unit, might be 14 unit now.
Right.
But I've just done that this will be the second year I've owned the cabin.
Yeah, how many times can she do that?
Yeah,
in a year?
that's-
I don't think that, so like with a home sale and the 2-year residency rule, I don't think that's into play. I don't think it's a matter of a 2-year time period. I think it's, just the qualifying as a like kind to a like kind.
So I'm trying to be that I'm going from a Airbnb to a commercial.
Like a single.
Mhm. I mean, I would, with all things, ask a qual. You might check a 1031 advisor, but I think it would be doable.
I think it's.
And it's
terrifying.
not really, I don't think that the 2-year rule doesn't really have an impact.
Yeah, I'm not sure.
Because it's all rental properties.
I'm waiting to spring this on my accountant, cause he's always like, oh my god.
Well, the thing about
Stop
it is.
doing what you're doing, like, take a
Yeah.
break,
Right.
relax. No, stuff to do.
Yeah, yeah, I mean, it's definitely a good tax advisor question. Or, 1031 advisor. So yes, you are. So let's say you made some gain in Myrtle Beach, and then you have that sitting there, and you're gonna make a gain in Pigeon Forge. So now, let's say together that's 200,000 and you buy this property for 1 million. Well, now that new property is only gonna be said to be worth 800,000 because you subtract the million from the 200,000 gain sitting there. then maybe you'll sell that for 2 million.
That's my plan.
So it'll be 2 million minus, not 1 million, it'll be 2 million minus 800,000. So your taxable gain is, whenever you get out of it, you're gonna have the largest capital gain. But
Unless I keep it until I die and then my daughter.
then
has
you
to
keep
do it.
doing it. Yeah, that's right. Right, exactly.
Crazy.
This is a basic example of a 1031 exchange, so you own a $4 million investment property with a tax basis of 3.5 million. So you would have a $500,000 capital gain, and you would like to sell this property and purchase a $3.975 million McDonald's in Canton, Ohio. You plan to use a 1031 exchange intermediary to handle the transaction. You exchange your 4 million property for the $3.97 million property and the adjoining lot worth $275,000 for a total value of $4.25 million. This means that there is no boot in the exchange, which is cash left over, and then you would qualify for the tax deferral on the $500,000 capital gain.
So it's similar to what you were presenting yourself. And yeah, there is always a question of what are tax rates today, what would they be in the future? And you know, what your long-term goals are when you're thinking of doing 1031 exchanges.
Good.
Yep.
Real estate professionals, so this is when a realtor also has rental properties. She briefly mentioned this earlier, but more than 50% of personal services and over 750 hours annually spent in real property businesses may qualify you as a real estate professional for tax purposes. And then having this status allows you to classify rental income as active income, and then you can deduct rental losses without the passive activity limits, which can be a significant tax benefit.
Okay, our next Harry subject is about S corps and sole proprietors or individuals and LLCs. So are some of you already S corp? Yeah. Okay, so why would you want to become an S corp is that when you're a sole proprietor, you're filling a 1040 Schedule C. The bottom line is tax for income tax and also self-employment taxes on the entire income. If you're an S corp, then you're splitting your income into employment wages and business income. So the business income is not subject to self-employment taxes. And you might be thinking, well, what if I don't have enough wages? But that's okay, because your business income, as long as you have the profit there, you can take cash distributions out without paying income tax on them, without paying self-employment taxes on them. So the savings is in the FICA taxes, which is Social Security and Medicare. And those added together for employer employee is 15.3%. So when might you think about doing it? If you're earning at least 50,000 consistently on your bottom line from your business, you might consider it. You have to weigh the costs, which is your business tax return, your payroll service, maybe some legal fees for registrations and setup. But you might be able to save. You're not going to save a lot if it's 50,000, but if your income is 100,000 and you're not paying 15.3% on half of that, let's say, that's a better savings. So what is required though is that you have reasonable compensation. So the way to do that is to set yourself up as your S corp. You have the S corp and you're an employee of the S corp. And then you take payroll. So talking about that Social Security, when you talk about 15.3% in tax that you pay to Social Security and Medicare, when you're looking at what are you gonna get out of it? So Social Security, the maximum income or annual payout is at the most $63,012 if you wait to age 70 currently, you know, it changes year to year. Or if you just retire at 67 years old, then the max you'll get is 50,484. And how they figure that out is, number one, if you don't have a online Social Security account, you should get it. So you just go to ssa.gov and you get an individual login and you find out what is your income history. And what they do when they figure out what you're gonna get for retirement is they take your 35 best years of earnings and they do inflation grade the older income to equalize. And then that's when they determine how much you're gonna get from Social Security. So everyone should get that to find out, you know, what Social Security has in your account. Because sometimes there's mistakes and also it's good to know as you go along. So the thing about that payout is what?
You said to make sure you know what's in it. Can you dispute it or anything?
Yeah, you can dispute it. Yeah, like there's a guy at our office who's a bit older and yeah, his was off for some years, quite a few years back. And whatever reason, he had the paperwork showing what he made. And yeah, you can turn it in and
it was pretty interesting. I did it for myself.
Yeah.
Let's see how much I'm gonna get through on Social Security. It's like $1,200. I'm like, how am I supposed to live on $1,200?
Right, $1,200 a month, right, yeah, right, so that's the question is what should you want to earn in wages, what do you wanna put into Social Security versus what you're gonna get out? So if you look at how they do it is called Social Security bend points. And that's what you get per dollar contributed. So on the first $1,286 you put in, you're gonna get 90% paid back out per month. This is per month. And then 32% of what you put in is gonna get paid out up to $7,749. And then the last bend point is 15%, which is less than 15.3%. And that's $92,988 a year. 15% of that is what's gonna get paid out. So it's graduated, at any rate, 15% payout. If you have more in there, you're paying 15.3% and you're only getting 15% out. So it's kind of a losing proposition. So if you get an S Corp, then you have the ability to limit your employment taxes, what you're contributing. So the next definitions is about being an LLC or a sole proprietor for an individual. So an LLC is actually a legal definition. People frequently think, well, I'm an LLC, so what do I do for my taxes? It's like, well, you're an LLC, but you still have to decide if you're a sole proprietor or an S Corp. Because an LLC just gives you a blanket around your legal liabilities, the limited liability corporation. And that's something you set up at the state. You can do it yourself on the Ohio Secretary of State website. You come up with a name of your LLC. And you can be your own registrar, and you probably, I don't know the cost right now, but it's pretty low, like.
It's like $100.
How many?
It's like $99.
Yeah, like $99. And so now you're an LLC. And then the next thing you wanna do, if you're going to be an S Corp. So you can be an LLC and still use your Social Security number. But if you want to further separate yourself, then you have to get an employer identification number from the IRS. So like Social Security numbers are like 3 digits, 2 digits, 4 digits, and It's the same number of digits, but an EIN is just 2 digits and then the rest. Anyways, if you want a business bank account, you've got to have an EIN. And you should want a business bank account. Even if you're a sole proprietor, I would recommend it because you can just keep all your income going in there and all your expenses going out of there. And then you're not fumbling through your personal records to try to figure out what was personal and what was business. But the S corp is really good option if you are making a decent amount of money, so that your savings is going to be limited on what you're paying into Social Security. That's the main benefit of it, honestly. Does anyone have a question about that? Okay.
So estimated tax payments, some may be required to pay quarterly to the IRS, state, and resident city. The IRS requires 90% of current year tax or 100% of prior year tax to avoid estimated tax penalties. High income taxpayers have to pay 110% of the prior year. Ohio business income deduction reduces the need for estimates. Up to $250,000 of business income is non-taxable in Ohio. And then cities in Ohio impose a high penalty, 15% and interest, and then 10% on unpaid taxes. The estimates are required when tax is over $200. So always pay attention to your resident city estimates because they will come after you. Ohio cities and municipalities. Income earned on property sales is subject to municipal tax based on the location of each property. So when you're selling these homes, make sure you keep track of where those sales occurred. Verifying the tax location, as many mailing addresses cover areas outside of a municipality. For example, the address of Baldwin Avenue in Alliance, Ohio, 44601 is in Washington Township, and townships do not assess income taxes. A good source to help pinpoint taxing districts is the Finder, and I've also put the website in there for the Finder. And you type in the location, and it'll tell you exactly where it's at, and if it's in a taxing district. Pay careful attention and make sure you're paying tax only when necessary.
I'm sure you've all encountered that when you paid 15 different cities, $5 or $20.
I just wanna quickly add that if you give out a referral, like I gave a referral to my friends in Columbus and they used a different agent, but I made the referral fee off of it, you still have to file in Columbus or wherever the referral is. So fun fact, if you're referring a lot of
Yeah,
things, so
I think Ohio cities
they'll
are
come back and be like,
the worst.
you still have to file.
Yeah.
So, yeah.
They're the biggest bother of, and they take a lot of time to handle all the city issues that come up. And they do, you don't think the IRS audits, but cities go through every single
They'll come
return.
after you.
And they will look at every single property sale and find you.
And they said you have to file for 0, like you need nothing, but you have to file.
Yeah.
Wow.
And that's all we have for you.
Yeah, hopefully we didn't burn your brain.
Yeah. So we just gave kind of an overview, so be careful. There's lots of other rules and things that also could apply to those pieces of information we gave you. So it's always best to consult with the tax professional.
And we have some pens and highlighters and brochures and business cards out on the table. So feel free to help yourself.
Thank you guys so much. There's lunch out there. Everyone's welcome to grab lunch and stick around and ask them more confusing tax questions.
Yeah.
Oh my gosh. Can I get a picture with you guys?
Oh, yeah.
Oh, and can you?
All three of us?
Yeah. I'm not on the table.
It's on Facebook.
I know, right? Good.
I guess,
Here, I'm gonna put.
Oh,
good.
you can get
it too. I
Okay. I'm sure it was a bring a gal day.
Yes, I know.
You can change real quick.
Yeah.
Come on, let me put this in the bag. Okay, there we go.
Okay.
All right, I'm still recording.